Hello, everyone. Welcome back. This is Meyer Thacker. I'm the Senior Relationship Manager here at Zacks, and this is another part of our Lunch and Learn webinar series. And today we're going to be talking about the various different tools and analytics that are available in the Zacks research system to be able to prep you for earnings season. So there's a lot that we can, discuss here. A lot of really helpful stuff that helps, keep you organized and prepared for the expectations as well as the actual results that come out from these companies as they report earnings. So obviously all eyes are going to be on earnings this quarter. It's probably the most important quarter that we have, witnessed in a long time. I know it's kind of, we kind of say that for every quarter, but it seems like now in hindsight is a lot more important than, previous quarters with regards to understanding, what the results are, as well as what management is saying regarding what they're seeing about their specific businesses in the year ahead. So let's dive right into that here. So I'm going to open up my ZRS. And the first thing that we're going to do is one of the key things that we have with regards to just prepping for earnings season is to set up your events calendar. So if you have not done this already, we have a great events calendar. It's right under this events tab. And it is exactly how it sounds. It's basically a calendar, and you get to see all of the key data points that are expected to be released, by every single day of the month. So you can see here that there's a lot of macroeconomic data. You'll see like the jobs report, you'll see initial claims, you'll see other things here, but you can choose to turn that off if you want to sort of just, specifically focus on earnings. So if you uncheck the economic events and go there, you'll see the companies in your portfolio or your watch list that are expected to report earnings. Now, how do you set this up, right? So if you have not set this up before, or if you have an old ticker list in here that you would like to change, the best place to do that is to go up right here in the tools section and click on under ticker list. And you can either start to build your own ticker list. So we can say active active view edit, or create, one from scratch. Or if you have one that's already saved, I'm going to just load up one that I have saved here. And it's just basically a text file. So if you just have a plain notepad text file and just have a list of tickers in there, then you can just directly import that from wherever you have it saved on your computer. So I'm just going to open up this earnings certain portfolio, and that is then going to say, okay, it's reading exactly that portfolio, and these are the companies within that portfolio. Nothing really changed because I already had this loaded up here, but for you, if this is your first time doing this, then you'll start to see all of the companies that are in that file show up on here whenever they're expected to report earnings. So this is great to kind of just keep tabs as to when companies in your portfolio are reporting earnings, so that way you can dive into what the expectations are. Now, you can also integrate this with your Outlook calendar. So if you want to make sure that you get alerts from Outlook, or if you have like your personal phone synced to your Outlook calendar, you can easily do that by, if you click on this list view and click on go. It will then show this in list form, and there's this button right here that says create iCalendar file. So if you click that, it'll generate a specific file that Outlook can then sync with, and all of these earnings are then going to be downloaded to your Outlook calendar. So pretty straightforward there, pretty easy to do. Also, we have in this events tab, the place to go to get live updates on companies that have reported is summarized right here under the surprise activity section. And so this place is where we can go to see, okay, which companies are reporting today, which companies may be reporting on Monday of next week or Tuesday of next week. So these are the companies that actually reported earnings today. And I have a filter on for just the S&P 500 companies. You can change that to the Russell 1000 if you want, or you can load up your own list of companies. So that same ticker list that I just uploaded, you can also upload here so that it only shows the companies that you're most interested in. And it just sums up the companies that reported today and what the numbers were, for both earnings and revenues here. And just also note that there are additional features right here on the top right corner. You can dive into some of the more earning specific details or revenue specific details. And wherever it is applicable, we also will provide you the guidance that the company gave. So if they did provide a guide for the full year, it should be listed right here. And right next to that is the estimate that we have. That's the consensus estimate by all the analysts that cover the company. So if they issued a guidance number, then that will show up right here. But of course, right now, a record number of companies are basically withholding guidance for the year. So this may not be as useful right now, this particular moment, but in normal times, this would be, filling up a lot better. You can also change the date. So if we, for example, were to go to, say, next Tuesday, you can see which companies are expected to report next Tuesday and what the numbers are. And just one other brief thing I forgot to mention. On the actual numbers, you'll see that there's a couple of different ways you can dissect what the results were. So you'll see that the estimate, the number of analysts that are going into the estimate are in this column right here. This tells us what the estimate was for the quarter. This is showing what the actual was. Standard deviation of estimates, the year-over-year percent change. So you'll see that not only are we presenting to you the percentage surprise, because they reported, $1.26, the estimate was $1.22. So that is a 3.3% beat. However, we also show this SUE factor, and that helps quantify the extent to which they beat a little bit better than even the percentage beat, because this looks at the number of z-scores that they beat by. Because we can see here that they beat by 4 cents, which is 3.3%, but the standard deviation of estimates was only 1 cent, 1 penny. So that means that they beat by 4 standard deviations. So that actually tells you, it presents a little bit better of a perspective as to how surprising that beat was, because the analysts were pretty closely together on that estimate there at $1.22. Standard deviation was so low. So this tells us that although the percentage beat is relatively small, the standardized beat in terms of z-scores was actually pretty big at 4 standard deviations above the consensus. So that's a really helpful feature just to look at. So just as an FYI, you can look at both ways to measure the beat of or miss of the company. We also have, for example, if I were to go out into the future, so let's say next Tuesday, these are all the companies within the S&P that are reporting next Tuesday, so you can see what those numbers are. If you click on any one of them, like I'll click on Starbucks, that will take us to the page that is sort of more of a deep dive into how the company historically has performed on a earnings surprise basis. So here we have the latest quarter. The estimate is 31 cents. You can see that here are the historical estimates for Starbucks and what they actually reported here. You can see the percentage surprise. And then you can also see things like, how much did the stock react, to the earnings number. So here we can see that last quarter they didn't, it dropped by about 2.25%. However, in June of 2019, the stock actually surged by over 9%. So, you can kind of look at that and say, okay, well, what happened that quarter? What was the number that surprised the street the most, that, made the stock react that big? So another feature that we have to help answer that question is if you go under the estimates tab, and if we go to surprises, this is the view that we're on right now, this consolidated surprise. That's what you're seeing here. But if you go one below that, that's the non-financial metric surprise. So this takes it into a lot more detail rather than just focusing on earnings and revenues. This will allow you to look at where the beat or miss was on specific segments or specific other operating metrics, sort of like the KPIs, the key performance indicators that the company is judged by. So for a company like Starbucks, which is obviously it's a retail store, same store sales is a big, driver of, the stock's performance. And so like if I were to click on this drop down here, these are all the various different metrics that the company provides. So these are all non-financial metrics, but if I were to go to the, comparable store sales or this, the same store sales, year-over-year percent change, and you can see right on this chart that, that quarter back in June, the June or, Q2 of 2019, which was reported on July 25th, had, the biggest, beat that you can see there. The consensus was 3.74% and the reported was 6%. So that was a pretty big beat. And, that's why we saw that. So it's pretty easy to audit that number. As soon as we get the updates, when companies report, we'll, present that to you right here. But just as a way to prep for earnings season, you can see and just, quickly eyeball, what are the metrics that the company, that the street is looking for with regards to that company. You can also look at how expectations have been, moving for the quarter. So if I were to go back to estimates and EPS, you'll see right here, there's the Q1/Q2 EPS revision trend. Now, I know it's labeled Q1 and Q2. However, that doesn't necessarily refer to Q1, meaning the January, February, March quarter. That just refers to the current quarter that they are about to report. And then Q2 always refers to the next quarter. So in this case, it lines up. But say starting next quarter, it'll still say Q1, but it's going to tell you the June 2020 quarter and so on. So Q1 just simply refers to whatever the quarter they're currently in. And so you can see the trend in that number. So heading into earnings season, which Starbucks is reporting next Tuesday, you can see that, estimates have really been slashed pretty significantly here. Right now, the estimate is about 31 cents, for that, Q1 quarter. So the expectations have clearly been, reduced heading into the number. So just as another way to just prep, how much have estimates come down, and therefore that might give you an idea as to whether, the company has a chance to beat that lowered, expectation, or if expectations are still too high heading into the number. So it just helps you, position yourself properly. Another metric that you can look at with regards to earnings season, especially before the company reports, is the Zacks Rank. So I'm going to go over here to under estimates and the Zacks Alpha scores. So we've done, obviously the Zacks Rank is a big part of our system. It's been the oldest product of Zacks, dating back to 1979. The company began with providing consensus earnings estimates as well as the Zacks Rank, which is a quantitative metric, measures the extent to which analysts are revising estimates up and down, in addition to other factors as well that measures the earnings momentum of the company. And in our studies, we've found that, companies that have a very favorable Zacks Rank, a number 1 or number 2, have a significantly increased chance of beating the estimate for the quarter. So, that can be very helpful too. So if you wanted to just, have a report ready with all the companies in your portfolio, you can just see, quickly in a report, for example, which companies have a strong Zacks Rank and therefore a good chance to beat, and which ones have a very negative Zacks Rank and which are at risk of, missing the estimate. So how do we do that? Well, we can set that up in ZPM. So heading over to the world of ZPM, this is what we call the Zacks Portfolio Monitor. And basically, it's a way for you to run reports on portfolios. So here I have the earnings certain portfolio loaded up. So these are all the companies that I had, from before. And I have this this report right here that's set up. that just shows me very quickly, and it might look a little small to you on the webinar screen, but it's it looks a lot better in person, or if you print it out to PDF or on paper, it looks a lot better in terms of fonts. But you can see here that I have the last reported earnings report date, the next EPS report date, the last earnings surprise. Here's that Zacks Rank, so you can just be quickly informed as to which companies in your portfolio have the best Zacks Rank heading into earnings, and which ones have the worst Zacks Rank heading into earnings. And then a couple of other metrics right here too, like the expected earnings growth quarter over quarter or year over year, and other factors as well that relate to earnings. So it's very easy to set this up. If you are interested in setting this up, I'd be more than happy to send this report over to you. It's just a quick and simple download into your ZPM. And so if you're interested in that, please shoot me an email, and I will be more than happy to send this over to you. Lastly, the other type of tools that we have that I personally like to use is in the quote monitor. So I have this, if you click on this quote monitor, this is just basically a way for you to keep track of companies and the intraday movements. So this is mostly 30-second delayed quotes, not real time, but it's most of them are 30-second delayed. However, down here at the bottom, there's a really good news feed as well, and we're collecting news from various different providers, including Reuters and other breaking news providers. So if you want even more timely updates on individual companies in your portfolio, setting this place up is really, really good as well. And so if you want also additional data on a specific company, then you can just enter the ticker here at the top and click on expanded quote. And now the news feed down here is going to be concerning the company that you have pulled up right here. So this is going to be very timely. Obviously, Reuters or other sources, even the AP, is going to report company press releases pretty quickly. So you should see that come through into here on a very timely basis. So I like to use this personally whenever there's a lot of news coming in, minute to minute, especially during earnings season. So that rounds out the list of tools that are available for earnings season. So now I'm going to pivot a little bit, and by the way, I forgot to mention, we also do have transcripts. So after the earnings call is completed, this transcript section will give you access to exactly the full earnings call, as well, both audio as well as the written portion. So that's definitely a big part of the earnings or the events calendar itself. This transcripts there. So those are the tools that I personally wanted to just mention as the top tools for just keeping on top of all the companies in your portfolio as we enter earnings season. So again, I'd be happy to walk you through this personally on a one-on-one training session. So again, if you do have any questions, or if you want to set up any of these things that I just mentioned, please do shoot me an email. You can reach me at mthacker@zacks.com. You could see that right there, mthaker@zacks.com, and I'd be more than happy to walk you through that. And so now for the remainder of the call, I just wanted to spend maybe 10 minutes looking through the one specific report that I personally love the most. And this is more in our research section under the market and macro strategy reports. If we click on this weekly sector and market earnings trends section, this report is my favorite, really. It's written by Shiraz Mian. He is our director of research here at Zacks, and he writes these reports on a weekly basis, especially during earnings season, that presents a big picture look at where we are in earnings. And right now, earnings are the most important subject of conversation right now for pretty much everyone on the street. All portfolio managers, all analysts are basically looking at with laser focus on what the reported numbers are, as well as what some of the commentary is going to be with this insane time that we're, facing right now. So this report is great to walk through, and I'm just going to give you a quick synopsis of it. It is a fairly long and thorough report. So I'm just going to give you a quick update as to how we're looking thus far. So far, through this week, we have about 83 companies within the S&P that have reported. So a little less than a fifth of all companies have reported. And thus far, aggregate net income is down, a whopping 23%. So, it's, I don't know if that can be considered a surprise given what we all know to be true with how the shutdown has really affected us. But, I can say that 3 months ago, I think we all would have fallen off of our chairs if we thought that Q1 is going to be, a 25% drop roughly from the same quarter a year ago. But interestingly enough, it's still on 2.3% higher revenues compared to Q1 of last year. However, what's interesting though is that a lot of this drop that we see here is attributable to banks. So if we look at specifically the finance sector, we have results now from a little less than half of all the banks within the S&P 500. And earnings for the banks are down, 47%, so that's staggering. It is on 1% higher revenues, but, that, bottom line figure is dramatic. And that's sort of what's weighing down the results. So that could be, a factor that is sort of disproportionately affecting the overall, S&P result thus far of these 83 companies. So since we do have about half of all banks reported, but only about a quarter or less than a quarter, less than a fifth of all S&P companies, so far, the banks and, the negative earnings there are, weighing heavily on the aggregate S&P, number thus far. We have consumer staples, no surprise there. That's one of the bright spots. That, sector is up. Total Q1 earnings are up 9% on 3.6% higher revenues, so no surprise there. However, there's also a couple of other sectors too, like medical, as well as utilities. So we can see that right here. So again, no surprise there. Healthcare stocks are doing okay. Consumer staples are doing all right, and utilities are doing fine. So again, as we would expect, these are your anti-cyclical sectors, and they're doing, just fine, with regards to earnings here. So now what the big question is that, we know that Q1 is going to be pretty bad. Q2, I think most investors are expecting to be pretty bad as well. However, we're seeing that estimates are falling for not just Q2, but also for Q3. So as we kind of move deeper into May, with a little bit still, with some lack of clarity as to when we can reopen the economy, Q3 estimates that we're now seeing are starting to fall as well. So it depends on, again, investors are really just focused on when we can reopen the economy, and therefore when can we have or if we have a consumer-led recovery in here. So, because of this, I think, what we're going to start to see, given this uncertain, and as this report is talking about here, so given this uncertainty, I think we will see further cuts in Q3 estimates. Why is that the case? Because if you see right here, this bullet point right here, the full year for 2020, with regards to earnings for the S&P, are expected to be down only about 16%. And I say only because, as a reference point, the S&P earnings declined by about 19% in 2008 and another 3.4% in 2009. So if we were to just compare the current estimates, and this would be reflective of both companies that have already reported, plus the remaining companies that that we're still collecting estimates on. Right now, the aggregate expectation among the sell side is about a 16% decline over 2019. And compared to that, 2008 was only a 19% drop. So I think that there is further room for downside as we kind of stretch into May, and potentially even for some places, maybe even into June, for this shutdown to continue. So, there may be a little bit more downside potential with regards to how much estimates are being slashed for the full year. We also see that a lot of companies are withdrawing guidance too, so that kind of hurts what analysts can predict, because with guidance being pulled, we saw that AT&T, for example, in this report specifically mentions AT&T, Kimberly-Clark are just the latest companies that have pulled their full year guidance. A lot of other companies are kind of following suit here, because ultimately, really no one knows when we can reopen the economy. So as we get further clarity as to when the economy can reopen, perhaps at that time management will issue guidance. But as of right now, companies are just pulling guidance entirely. So it's throwing up even more uncertainty as to what analysts are then forecasting for the full year. So we can see that in this chart here, the evolution of the Q2 2020 numbers. Back in February, we thought that Q2 would be a 3% growth quarter year over year. Now today, that number has been revised down by down to 28% contraction from the last year. So, and this may continue as we further walk into May and see that the key markets throughout the U.S. have not yet fully reopened, as well as parts of Europe and other parts of Asia that are still closed as well. So again, all eyes are sort of on that timetable for reopening the economy. So the big question that I think a lot of people have now is, well, because of all this uncertainty, right? Why is it that the market is so strong? How come we've seen such a strong rebound in all of the broad indices, in the Dow and the S&P and the Nasdaq, from those lows that we saw, given the lack of certainty? Well, it's because one of the reasons I believe is because of this chart right here. So this is telling us what the quarterly earnings and revenue trends have been for the previous 4 quarters and then the next 4 quarters. So, my interpretation of this is that we see that for Q1, the estimates have been slashed, and right now we're expecting about a 14% decline year over year in earnings. For Q2, it's going to be even worse. Analysts are now expecting a 28% decline, as I just mentioned, year over year. But then you can start to see that although Q3 is still in the negative, you can see that the rate of change is not as bad anymore, and you can see that trend continue into Q4. So ultimately, what this is saying is that analysts, as well as the buy side, really the investor community, believes that Q1 is going to be bad, Q2 is going to be worse, but the worst may be behind us starting in Q3, and then Q4 should be the start of the recovery, or early the first half of 2021 should be the beginning of the recovery. So perhaps Q1 and Q2 are essentially a wash. It's a sunk cost, and usually whenever there are one-time items, like a restructuring charge that a company reports or an asset write-down, most analysts will revise that that number out of the GAAP number into the adjusted non-GAAP number. So this is sort of a similar story where we have really, really bad numbers for a couple of quarters, but then the worst is behind us. And I think that's what the S&P and that's what the averages are really thinking right now. That's just my interpretation of it, but that's the only justification that I can see for why we've seen such a sharp rebound in the market. This negative trend right here, followed by that recovery. Also, there's another chart that I just wanted to leave you with, which is that this is a breakdown of how we're doing thus far in Q1, broken down by sector. And you can see here what the growth rates are, as well as what the beat ratio is for both earnings and revenues. And if you see down here at the bottom, we just saw that number here. So thus far, companies that have reported in Q1, for Q1, I should say, the earnings have dropped by about 23% year over year. And that's about a 68% beat rate on earnings. Revenues are up 2.6%, and that's about a 66% beat rate. That sounds high, but if you actually comp it to previous quarters, that's actually pretty low, the beat rate on earnings. And again, it's on lowered expectations too. So therefore, it's not as great thus far because, less companies are beating estimates compared to previous quarters, despite having lowered expectations going into the quarter. So it's, kind of a double whammy there. However, if we were to remove two of these sectors right here, for example, the financials, right, because we did see that banks, have just gotten obliterated, especially with the Fed cutting rates and, most of their net interest income, dropping pretty dramatically. If we were to remove financials, you can see that the numbers actually improved pretty significantly. So if we were to take the S&P 500 and simply exclude, the financials, then earnings have only dropped by about 2.7%. And the beat ratio increases pretty substantially to 79%, almost 80%. So that is one small silver lining. I guess you can say that a lot of the damage may be limited to the financials. And then beginning in Q2, I believe, we also have this excluding oil stocks. You can see that it's not a big difference here, taking the S&P minus oil. It's not a huge difference. However, I think that when we get Q2 numbers, this will start to show a pretty significant difference. Because keep in mind, this is only for Q1. And we saw that the WTI crude oil price, plummet just this week. So we're now in Q2, so we're going to see a pretty ugly picture for earnings in oil stocks in Q2. So what I'm trying to say here is that, the S&P 500 may be disproportionately affected by two specific sectors, banks and oil. So if we were to, subtract those two out, then the aggregate number may not be as bad. So again, that could be another reason why the S&P overall might be faring a lot better, or why the Nasdaq might be faring a lot better than the S&P, because the Nasdaq, is, as we all know, doesn't have a whole lot of exposure to to financials as well as oil stocks. So overall, that's my basic summary. The numbers are very bad for Q1. It's going to get worse for Q2. The big question then is, can we stem the losses beginning in Q3 or not? So if there is a confirmation that the rate of change of earnings decline is dropping, or should I say getting less negative, as we can see in this chart, then we could see a second half recovery in the market. And also, if a lot of the impact of earnings is limited to one or two sectors, then we can see those two sectors underperform the S&P, but everybody else mostly could set the stage for a recovery in the second half. So again, all eyes right now are on what management and guidance are going to tell us for the quarter, but thus far the numbers are not looking good, but that's pretty much what the expectation has been. But I think it's also important to look at specifically by sector, and to point out which sectors most of the damage is confined to. So I think looking at oil and banks, and looking at S&P earnings without those two is going to tell you a little bit more as to what the core operating earnings for the S&P might be. So with that, I'll end our call today. If you have any questions, if you want to review this report or do anything with regards to setting up this ZPM report for your portfolio, or look at your stocks in your watch list with regards to earnings, or if you want to do a deep dive into any of these reports on the aggregate front, I'd be more than happy to help out. You can again reach me anytime at mthacker@zacks.com. That's MTHAKER @zacks.com. And thank you for joining. I look forward to hosting many more webinars just like this in the future. All right, thank you everyone. Take care.